So welcome back. Today I want to look at the partnership question for May 2016 question 2. So let's go on. We have been told that Maria and Bakari are in partnership and sharing profit and loss in the ratio of 3/5 for Maria and 2/5 for Bakari. And the partnership deed provides for interest on capital at the rate of 5% per annum. So the partners are entitled to annual salaries of 1,700,000 for Maria and Bakari respectively. So the following balances were extracted from the book of partnership as at 30 April 2016. So you have the capital accounts and the current accounts for both Maria and account. You can see the amount. Then you have the inventory as at 1st May 2015. You have 19,000. Building and costs at 500, furniture at costs 3,200, renovation of building 1,500. Then you have the sales 87,460. Then you also have the purchases of 62,140, rent and rates 400, electricity of 500, bank balance of 1070, accounts payable 6,200, account receivable 616, repair and maintenance of 1320, general expense 4700, insurance of 300, carriage in one of 916, bad debt written offs of 217, salary and wages of 2400, office expense 600. We have the provision for depreciation furniture 1st May 750, cash balance 230. We have the drawings, which is 2,800 for Maria and Bakari 2,000. And you have now the addition information. So you have the addition information. We are told inventory as at 30 April 2016 was valued at 15,600. If you assume you have the 3 zeros at the top, so the closing inventory will reduce the cost of sales as well as will appear on the current asset. So this is the first adjustment we are going to do. Then we are told depreciation is to be provided for as follows. We have the buildings 2.5% per annum cost, furniture 10% per annum on reducing balance. So one you have a straight line method, the other one you have a reducing balance. So we are going to calculate that and find the depreciation on that. Then we also have the foreign amounts were owing us at 30 April 2016. You have the salary and wages of 200 and electricity of 90. And then we also have an allowance for doubtful debts amounting to 200 is to be made. Then insurance paid in advance as at 30 April 2016 amounted to 40 shilling. During the year ended 30 April 2016, the partners withdrew goods from stock for personal use as follow. Maria had 150 and Bakari 590. So we are required to calculate the partnership income statement as well as partnership the financial position. So let's not waste time and indulge on that. So let's start. We are going to start with the income statement. So Maria and Bakari income statement for the year ended 30 April. So we are going to have the particulars and explanation as well as the amount. So here have we traced the full amount so that we can also be able to view. So we are going to start with the sale revenue as we have been given to be 87,460 from our trial balance. Then we have to raise the opening inventory, which we had been given to be 62, which had been given to be 19 million or 19,000 according to this trial balance. So I have a 19 million here. So then we also have the purchases. We have to add them, which add up to 62,140. Then you also have to raise the drawings from Maria and Bakari. So the drawings they are going to reduce our purchases as well as will increase our we'll increase the drawings under the financial position. We are going to see that. So for now we are going to rest the drawings, which is 150 plus 590 to get the 740. Then you have the carriage in one from a trial balance, which is 960, and the cross-in inventory, which we have, which is going to reduce the cost of sale. The adjustment is 15,600. So we get that. So our total cost of sale is 65,760. So when we less the sale revenue of 87,460, we are going to get a gross profit of 21,700. So what we need now to do is get our expenses. So our expenses, we are going to start with the rent and rates from the trial balance. We have been given us to be 400. Then you also have the electricity, which has been given as 500,000. Then you also have the accrued of 90,000. So if you check on our electricity, it's going to be added as an expense, and also will appear on the liability. The accrued electricity will appear on the liability side. So we are going to get the 590. Repairs as per the TB is 1320. Then you also have general expense of 4,700. Insurance, we had prepaid of 40,000. So we are going to subtract that from the insurance. What we are owed to get 260. So you have to deduct the insurance expense as well as record the prepayment in our current assets. Then you also have the salaries. We are going to add these 200,000 in our allowance made for doubtful debts. So the 2.4 plus the accrued of, we have the owings of 200. Sorry for that. It is salary and wages. We have an accrue of 200. So we add that to our salary and wages to get 2,600. This one is going to be added to the salary, as well as the accrue shall be treated on the liability side. Then you also have office expense, and that one is given from the TB. Also the bad debts of 270. Then you also have the adjustment for allowance for doubtful debts. Yes, this one, the one that we had been told that an allowance for doubtful debts amounted to 200 is to be made. So we are going to deduct it from the receivable as well as add it to the expense. So we have first of all add it to the expense, and then we shall deduct it from our trade receivables. Then you also have now the depreciation. So we have a building and renovations here. We are told renovation of building is 1,500. So this one is not going to be an expense. This is a capital expenditure. So we are going to add it to the building at cost, which is 8,500 plus 1,500. So that we get the 10 million, which we are going now to get we are going to get the 10%, the 2.5% per annum on cost. So this one is a straight line method. So we get 2.5% times 8,500 plus 1,500. Since this one we are renovating. So to get its depreciation, we add both. We get 10 million times 2.5 to get 250,000. For the furnitures, we have been told is a reducing balance. So we are going to subtract the accumulated depreciation, which was 750. So we are going to get cost, which is at 200 minus 750, which give us 245 million, then you get the 10%, which you are going to get to 45,000. We are together up to there. So that is the depreciation part. So we get now the total expense, which is 11,935,000. So it's subtracted from the net sales, from the gross profit. So we are going to get now 9,765,000. So that is our net profit. So this is the income, how to create the income statement for that partnership. So let's continue and now share the profit. So we are going to trace this table of profit and loss appropriation account. So we have Maria and Bakari. So the interest on their capital, we have been told it's we are given on 5%. Let's look on that. We have been told that the interest on capital at the rate of 5% per annum. So we have their capitals here and their current, which is 12 and 5,000. So the 5% of 12 we get 600, and that one for 5,000 you get 250. So the total will be 850. So we have their partner salaries. We have been told they are given 1 million for Maria and 700 for Bakari, as well as get the total. Then now we are going to get the residual profits for Maria and Bakari. Maria is given 3 out of 5, while Bakari is given 2 out of 5. So our residual, or what we are going to get now, the residual profits, we have been given it is 9,765. So the residual profit is 72.15. So I have gotten this by the net profit was 97.65. So you have to subtract the interest on capital and the partner salaries. So you have 97.65 subtract 1,700 and 850 to get 72.15. So to share, you trace their ratio, which is 3 out of 5 on Maria, as well as 2 over 5 on Bakari. So 3 out of 5 times 72.15. So you get 43.29, as well as for Bakari 28.86. So this is the share of their profit. So the share of their profit, the residual profit after deducing their partner salaries and the interest. So the total share of profit that you are going to do is to add this. So 43.29 for Maria plus 1,000 on salary and interest on capital. So the total share of the profit is 59.29. Well, that one for Bakari 38.36, so that it can accumulate to 97.65. So that we shall have a null balance. So that is now the profit and loss appropriation account. So we go to Maria Bakari's partners account. So I also wanted to create this one so that we can have a more understanding. So we have the opening balance for Maria and Bakari. So we have to look this from instructions. So we have been given 3,000 for Maria, and Bakari also given 1,000. So our opening balance, as we can see, current accounts, Maria 3,000, Bakari 1,000. So those are the opening balance. Then you have the total profit of shares, which I have seen. It's 59.29 on Maria and 38. We less the cash drawings. So we have drawings of Maria to be 2,800 and 2,000 for Bakari. And also we had been told that during the year, the patrons withdrew goods from stock. So we have Maria 150 and 590 for Bakari's. So this one we said they are going to reduce the purchases as well as increase the drawings, so we have to subtract that. So after we add this and subtract this, we get 79 as our closing balance, as well as 2246 on Bakari. So that is all about the partner's current account. So we are going now to utilize to do the next part of the question, which is the financial position. So we start with our heading. So Maria Bakari, statements of financial position. So we are going to determine the net book value. So we have the cost, accumulated depreciation, and as well as the net book value. So for the building, we said we have the renovation. So we are going to add the 85 and the 1500 to get the capitalized into the building. So we get the 10 million since it was a capital expenditure. So 10 million depreciation we calculated and got it is 250. So we subtract, our net book value is 97.15. For the furnitures, we were given at cost that 200. So we have to add the depreciation, accumulated depreciation on 750 plus the provision for this year, which we have been given to be 245. So we add that to get 995. So the total net book value will be 22,005. So let's continue. So the total will be 11,955. For the current assets, we are going to start with the inventories. So we had been told the closing inventory was 15,600. So we trace that. Then also we are going also to have the trade receivables, which was 50. The trade receivables had been given 6,200, and here we had an allowance for doubtful debts amounting to 200. So we are going to reduce that. So we are going to reduce that by 200, so that we get for the trade receivables we have been given as 5660. So we have to subtract that 200 to get 5460. So we get 5460 after deducting the provision for doubtful. Then we also have prepaid insurance. We had been given that one to be 40 from TB, as you can see. Insurance paid in advance, which was 40. So you have to show this in current assets. So the 40,000. Then you also have cash in hand, you have been given to be 230. So we get our total current asset to be 21,330. We add with an NCA, get that 3,285. So we go to the capital and liabilities. So for the capitals, I'm going to start the capital for Maria, which is 12,000 as given. Beyond the current account, you have seen it is 59.79 as the total. Bakari the same was 5,000 capital. We also had the current account of 2246. So the total capital is 25,000. Then we go to our liabilities. We don't have a long term, so we are going to trace the only the short term. So the current liabilities, we have the account payables. We have been given to be 6,200 from our TB. Then accrued salary had been given to be 200. Accrued electricity also was given to be 90. I think that one 290. That one is given here. Then we continue. We also have bank overdraft. of 1070. As you can see from TB, the bank balance, it is on the right hand side. So here we have the debit and you have the credit. So debit, we have the assets and the expense. Credit, you have liability and the revenues. So since this is the side of revenue and liability, we are going to show it as a current liability. So let's continue. So that one is 1070. So the total liability is 7560. So we also have now we add the total equity plus liability. We are going to get is 32785. For now I have a variance of 500, which is fall short of 500. So for this account, I think the proceeds from the furniture disposal or gains or loss or any discrepancies that I might have excluded from the cash flow, if confirmed, may be bringing these variances. Otherwise, I think this is a set of faithful which has been built with only what is given. So, but if you have any additional information how to treat this variance, you are most welcomed. So if you have any question, please comment and I'll gladly help. So this is how you are supposed to do that partnership, and if you do like this, I'm sure that most of the marks you are going to pass and to get. So that is what you are supposed to do on that question on income, statement of partnership, as well as the financial position of partnership. So thank you. Let's meet